Welcome to today's explainer. Look, get ready because we're about to completely reframe how you look at market charts. If you've been relying on standard textbook definitions of trading, you might want to grab a notepad. Literally everything you thought you knew is about to be challenged. We are going to break down the actual real mechanics driving the markets today. Okay, let's dive right into this. You've got to ask yourself, why does this specific scenario keep happening? You analyze a chart, you meticulously place your trade, and then, bam, you get stopped out. And then, just to add insult to injury, the market immediately reverses and rockets in the exact direction you originally predicted. It's an agonizing cycle, right? And it's a trap that is quietly costing everyday retail traders thousands of dollars. To understand why this happens, we have to look at the stark contrast between illusion and reality. On one hand, you have the retail strategy, this widespread belief that obvious chart patterns are safe entry points. But then you have the smart money reality. Large institutions, they are not looking at those patterns the same way you are. They're actively hunting retail traders' stop losses. They literally need those pools of orders just to fill their own massive positions. Section 1. Inducements and Retail Traps. How you become the bait. To understand how you inadvertently become the bait, we first have to understand the concept of an inducement. An inducement is, well, it's essentially a trap. It's designed by smart money to entice market participants into entering trades early at highly obvious levels. Think about classic retail patterns, like double tops or double bottoms. Smart money uses these exact patterns to bait the impatient trader into jumping into the market prematurely, setting them up perfectly for the sweep. And that brings us to liquidity. In trading mechanics, liquidity simply refers to a concentrated area of pending orders, most commonly your stop losses. You see, smart money moves such massive volume that they literally cannot enter the market without someone taking the other side of their trade. They need your stop losses to fuel their own buy or sell orders. The golden rule here is simple, but man, it is brutal. If you cannot spot the liquidity on a chart, you are most likely the liquidity yourself. And this brilliantly illustrates the exact anatomy of a retail trap. Let's walk through these steps together. Step 1, a beautiful double bottom forms at a perceived support level. Step 2, retail traders see this textbook pattern and they just eagerly enter their buy orders. Step 3, naturally, they place their stop losses safely tucked just below that support line. And step 4, smart money deliberately manipulates the price down, sweeping those stop losses, accumulating enough liquidity to fuel their giant buy orders. And then the price absolutely skyrockets exactly as you originally predicted, just without you. Section 2. Spotting the liquidity sweep, seeing through the matrix. Now that we know exactly how these traps work, let's identify them. Take a look at these common inducement traps. What do you notice? Double tops, double bottoms, support and resistance breakouts, strong highs and lows. These are all the classic retail trading concepts that everyone is taught on day one. But the reality is, these exact areas are where smart money generates their liquidity. When price approaches a major point of interest, like a supply or demand zone, these patterns will inevitably form to entice traders to enter way too early. So what actually confirms that a trap has been sprung? Well, you need to look for the V-shaped reaction. This is a sharp, violent price reversal that immediately follows the sweep of those stop losses. If the price just slowly meanders after breaking a level, it might just be a standard trend continuation. But a valid, powerful liquidity sweep requires that aggressive V-shaped snapback. That confirms that smart money has just grabbed the liquidity and is now rapidly reversing the market. Section 3. Step-by-step entry strategy. Trading alongside smart money. So the crucial point is, how do we pivot from understanding this frustrating problem to actually utilizing an actionable solution? Here is the 4-part framework you need to start trading like a professional. Step 1, map out your market structure on a higher time frame to understand the objective of the price. Step 2, mark your point of interest, like an extreme supply or demand zone. Step 3, wait patiently for an inducement to form and subsequently get swept. And step 4, confirm the market shift before entering. I really want to stress this heavily, guys. The entire battle is won in the patience required between step 2 and step 3. Seriously, do not rush the process. Let's talk about this stark difference in risk between your chosen entry zones. When price pulls back, it often leaves multiple zones behind. If you enter at the near demand zone, you are highly prone to being wrong twice. Why? Because price is likely going to sweep that near zone's liquidity, stop you out, and hunt for the extreme demand zone anyway. If you enter again there and it fails, you've taken 2 losses. But if you patiently wait for the extreme zone right from the start, you protect yourself from those deeper liquidity sweeps, and you're typically only going to be wrong once if the broader setup simply fails.
But hold on. Even after that extreme zone is tapped and the liquidity is swept, you absolutely shouldn't just jump in blindly. You need to wait for the market shift. This means waiting for the internal, lower timeframe structure to break a prior swing high or low. Essentially, you're waiting for the smaller waves inside the big trend to reverse and prove the big players are finally stepping in. It's this multi-timeframe alignment that gives you the ultimate confirmation that smart money has actually taken control.
Section 4. The Psychology of Success. Joining the 1% Club. Now, let's move away from the technicals for a moment. Because honestly, none of this matters if we don't address the heavy emotional toll of trading. $5,000. I mean, imagine losing that in a single day. The deep pain, the anxiety, the suffocating self-doubt that comes rushing in after a massive loss is incredibly real. You start wondering if you can even pay rent, your confidence totally shatters, and you genuinely question if choosing to be a trader was the worst mistake of your life. Listen, every single successful trader has stared down this exact number and the despair it brings. To survive this exhausting marathon, you need a profound mental reframing. When you get stopped out, when the market just takes your money, it is not a bad day. You have to consciously reframe it as a character-building day. Every single loss, every blown trade, it's just raw data. It's feedback that, if you analyze it correctly, mathematically makes you a sharper, better trader for the future. When those darkest moments hit, when nobody believes in you, when the lights are about to be cut off, and you are just physically exhausted from losing, you need to hold on to this comforting yet incredibly powerful realization. These too shall pass. The rough times are not here to stay. They are only here to pass. You must channel absolute obsession. You have to develop a succeed or die trying mentality to escape the 9-to-5 grind and join the 1% Club. Remind yourself every single morning it's not over until you win. Quitting is literally the only way to guarantee failure. If you keep pushing, keep learning to spot the liquidity instead of being the liquidity, the whole shebang will eventually start to click like clockwork. Take a deep breath and review your goals. Because if you stick to your rules, control your psychology, and just wait patiently, you are just one trade away. But you have to ask yourself, are you going to continue trading the illusion and being the liquidity? Or are you finally ready to wait in the shadows and hunt alongside the smart money? The choice is entirely yours. Thanks for joining me for this explainer. Now go study those charts.